Okay, so for Forex in 5 this week, in G3, the story is all about politics. So US, Trump and Biden had their recent debate. Seems like Trump came on top of that, but didn't really give that much confidence generally from a political standpoint. But the dollar seems to have had a bit of positivity in the short run. Over in Europe, clearly we've seen French elections taking place the first round anyway. It's quite clear Macron's probably made a bit of an error, with Marine Le Pen being far stronger than expected. So that is the likely outlook for France in the short term. However, the sort of like extreme views of the Marine Le Pen party are probably less than what they used to be maybe 5 to 10 years ago, so perhaps it's not too much of a negative in Europe, but we'll see how the euro fares. It did drop to 106, sort of coming back up to 107 versus the dollar. In the UK, naturally we have the general election on July 4th. It's becoming more and more a foregone conclusion that Labour are going to come in as a new regime. Now, clearly this has its fiscal ramifications. It seems like the pound and stocks in general are trying to weigh up how to digest a new Labour government, but we'll see if they actually follow through on their manifesto. But from a macro standpoint, we're sort of seeing 45 basis points of cuts currently being priced into the Bank of England at the moment. I think that's probably thereabouts, 2, maybe 3 cuts in the future. The US seems to be stuck at 1 for this year, and clearly Europe have already cut. Whether they go again, we'll probably wait and see what happens in France, but clearly the loosening cycle has already started among these developed market countries. But I think we'll need to see the dust settle from a political standpoint to see how many further cuts are going to happen. And then clearly it's all going to be data dependent. Is inflation going to drop, as some people are fearing? That tends to be my view. I think inflation is artificially a little bit higher at the moment, but clearly there's a lot of moving parts, and we'll have to see what happens over the coming months. In Nigeria, so we've actually seen quite a lot of stability in Nigeria. The rates have been fluctuating around the sort of 1480 to 1510 sort of level for many, many weeks now. Now, the stability is clearly a positive for the country. However, these high rates are not exactly the best. We want to be seeing rates back down towards 1200, maybe even 1000 in the future. Now, where's that dollar demand going to come from? It's tough to say. It seems like if there's going to be any further CBN intervention, they're clearly using what seems to be the last of their immediate reserves. Clearly they could get some more dollars in country through various trade deals and negotiations, but that tends to be a lot further down the line. If we see a spike in the rate up to like 1600, I imagine the CBN will try and intervene, but I think it's fair to say that it's going to be their last bullet they're using in order to defend the currency. I appreciate it's the CBN standpoint they don't defend the currency, but we've seen them intervene in the past, selling dollars into BDC, selling dollars directly into local banks. I think foreign reserve levels are really now starting to get stressed for how much more they can do that in the future. So the story is going to be, can they attract any FDI? Can they attract any further foreign portfolio inflows in country? Potentially. Ultimately, rates are going to have to be significantly higher for treasury bills and bonds, maybe a new euro bond in the future, to try and attract some of this dollar inflow. But in the short run at the moment, it seems the backs are against the wall. In Kenya, the new finance bill clearly went down quite badly. I mean, some of the fiscal measures that were being proposed by the government were pretty unpalatable. Things like 13% VAT on bread and other sanitary products, for example. So clearly some of that has been wound back, but the political unrest has been notable, to say the least. Clearly it's a much younger demographic that are protesting at the moment, but it took its toll on the Kenyan shilling last week. We saw rates back up towards 130. Now the rates have actually appreciated this week back to sort of 128 levels. However, I think this is less about positive sentiment. It's probably more about a shortage of Kenyan shillings and a bit of a surplus of dollars, probably driven by the CBK to sort of paint that narrative that there's nothing going wrong politically. Look at the Kenyan shilling; it's still appreciating. So we're going to monitor that quite closely. In Tanzanian shilling, Again, a lot of appreciation seen recently, which is a positive. It seems that the recent floods that have been waning on the currency quite a bit have now started to subside, both figuratively and literally. So it's good to see some rates back below 2,800 in Tanzanian shilling, but we'll wait to see what the coming months have to show.